Welcome to our 7-part series on avoiding 7 costly crypto tax mistakes. And of course, this is crypto tax mistake number 1, brought to you by Blocko. So mistake number 1 is paying higher tax from poor organization. And remember, your goal is to get a crypto bullseye. Our goal is to help you get there. Quick disclaimer though, remember all of our content is for informational and educational purposes only. This is not tax, financial, or legal advice. I'm a CPA, but I'm not your CPA. And of course, tax advice cannot be dispensed unless there's an official engagement letter anyway. Okay, so paying higher tax from poor organization. How does this happen? Well, do you enjoy wheel spinning, wasting time and energy, getting surprise tax bill, or paying more tax than you should? Of course not. Nobody likes that. Nobody likes wheel spinning and wasting time and energy in anything, regardless if it's taxes. But nobody likes surprise bills or paying more tax than they should. So that's one of the main reasons right there not to be poorly organized. Now, crypto data organization is critical. Remember, it's easy to set up multiple wallets, and most people have multiple exchange accounts. In the Western world, you'll hear people say that we're overbanked, especially in the United States. We got multiple bank accounts, sometimes personal and business, credit card accounts, and so on and so forth. But when it comes to crypto, it can be even more scattered about because most wallets are free software. So it's easy to set up the wallets, right? And also multiple exchange accounts to be able to trade various different coins because not all the coins are on the same accounts. So if we think we're overbanked with bank accounts and credit cards, you ain't seen nothing yet when it comes to crypto wallets and crypto exchange accounts. So that means suddenly your crypto transactions are scattered about everywhere. It's called the cluttered crypto transactional landscape. It's like a bomb went off and now you got to go round and pick up the pieces all over the place, which of course in this context is all your crypto transactions. So why is crypto data so challenging? Well, even after, let's see, we're actually 13 years down the road as far as Bitcoin goes, but let's just say even after I've been in the space for 8 years, and still to this day, I'm so shocked that there's a lack of a memo field in many of the apps. Now, I'm seeing that more and more have them, but still there's a lack of a memo field and being able to add a memo, probably the single critical, most important piece of information. Now, if there is a memo field, then people also don't add memos. So there's no memo field available. And then you have, well, now there is one available and people just don't use it. So adding a memo is critical to being able to sort out what your transactions were for. Were they transfers? Was it paying someone? Or was it a trade or anything like that? No matter what it is, you should always add a memo. So in addition to that, failure to document key transactions. If you're sending crypto around or doing something complex, or especially setting up pools, always good to keep a memo on the side documenting. It doesn't have to necessarily be all of the finer details like the exact amount of the token, all the decimal places and stuff like that. But just it could be even a rough capture of a key transaction is enough to be able to sort things out. And also poorly named files. And we have to save a lot of files in crypto. Sometimes we can, of course, import transactions easily, but we're still relegated to having to deal with files. And of course, most people just forget about crypto aside for a second, but mostly people save files and they have a poor file naming scheme. That will trip you out there. To talk about wheel spinning, that's where you'll get stuck right there. So, and another one, of course, is letting too much time pass by before dealing with it. So in the legacy world, in theory, you can go back and recreate a profit and loss statements and any type of activity really with bank statements and credit card statements. But in crypto, the longer the more time that passes by, the more difficult it is to deal with it. So you kind of have a degradation, especially if you have missing memo fields and so on and so forth, right? Because now you're going to have to fall back and rely on memory. And of course, the more time passes by, the less you can remember. So the more time passes by creates a bigger headache. And of course, trading without knowing the tax impact. You could have huge gains And you could have potentially offset some of those gains with losses. However, if you didn't know that you had built-in losses, you may not actually sell for a loss, also known as tax loss harvesting. You hear that concept being talked about. So that's what we're talking about here. But you got to know where you are. So if you have a high gain, you're like, wow, look, here's the loser here. I don't want to hold this token anymore. I can take a loss, offset the gain. But if you don't know that, you could miss the opportunity. And of course, not paying the proper estimated taxes. So let's just take the example of, you know, Bob works for a company, gets a W-2. And of course, the company withholds all of the taxes. And if it over withholds, you get a refund at the end of the year. But when you're dealing with capital gains and losses, there's no withholding. You are responsible for being your own withholding agent. So that means you can get tangled up. So what people can do is actually, when instead of paying taxes in on a quarterly basis, based on what the estimated taxes divided by 4, people basically are financing their crypto buys with their tax money. So what it means, instead of taking the money, stashing it to the side and paying some taxes, they're churning it over and over again, reinvesting it into crypto. Well, then what happens? All of a sudden you find out in the 12th hour that you got a huge tax bill and you didn't put the money aside and you didn't make your estimated payments. Now the crypto market has dropped. Now you have to sell coins for a low value to pay for your tax liability. So it's insult to injury, because at that time you don't want to sell. When the market's down, you want to continue to hold, waiting for the market to come back up and so forth. So you can get burned in that way. Again, financing, churning your money that should have been aside for tax, churning it over again in your crypto trades. That's how you get burned. That's wheel spinning. That's how you create tax headaches and expensive mistakes. All right, so get organized. Don't get tax wrecked. Again, based on all the things we're talking about, you could pay 37% tax rather than 0%. So for example, Bob, again, has not been managing his transactions very well. And of course, he thought that he sold a high gain coin. Let's say it's Bitcoin, for example. And he thought that he was going to sell it on long term. But guess what? He didn't have his dates wrong because he didn't have his information organized. He wasn't using crypto tax software. So of course he sold it in the short term. He's in the highest tax bracket, 37%. He gets dinged there. Whereas if he had a long term, in his particular tax situation, he would have had a chunk of that with a 0% rate. So selling high gain crypto to pay a surprise tax bill, nobody wants to do that either. So you could get caught in a situation where you're having to sell the crypto that you don't want to sell, or the market could be down and you're having to sell crypto in a down market, and you don't want to do that either. So of course the insult to injury is when you sell to pay your tax, guess what? You got to pay tax on the funds that you need to pay another tax bill. So if you sell crypto for $10,000, you're going to have to pay, let's say it's 100% gain. You're going to have to pay tax on the $10,000, and then the leftover amount you can then go pay your tax bill. So you got to pay tax on the funds before you can use the leftover amount to go pay the taxes that you should have paid a long time ago in the first place. All right. Okay. So basically getting forced to sell at the wrong time. You don't want to get caught in a squeeze play like that. So these are the ways that you can have expensive tax mistakes and pitfalls from not being organized. And of course, the number one thing you need is a process, a plan, a roadmap, a blueprint. And that's what we are here for. Remember, your goal is to get a crypto bullseye, and Crypto Blocko's goal is to help you get there. So tune in and look out for the other 6 parts of this 7-part series.